Konnichiwa! This week's news in the UAE. DP World, listed on the Nasdaq Dubai, announced that it will expand its port in Ho Chi Minh City, Vietnam. This is one of 11 ports that DP World is hoping to expand on in the next 12 to 18 months. This should contribute strongly to earnings in 2010. Even though we believe that earnings will slow in 2009, recent pickup in the Baltic Dry Index is a very positive indicator for shipping and port stocks. Therefore, we retain an overweight recommendation and price target of 48 cents per share on DP World. District cooling company Tabreed, listed on the DFM exchange, has also announced that it's looking to expand its district cooling plant capacity by 16 and pushing towards a total of 900,000 refrigerator tonnes by 2011. This is a large expansion, and given that Tabreed already has high borrowings, will need to borrow even more through either a bond or a Sukuk or Ijara facilities in order to finance this expansion. We still believe that Tabreed in the short term has a shortage of cash flow and profitability from these plants, and therefore we remain underweight on the stock and believe that investors should switch out of Tabreed and into some of our other preferred stocks. ABAR Investments, listed on the ADX, has teamed up with Austrian-based Berdoff in order to establish a joint venture to invest in medium-sized technology companies and real estate portfolios across Europe. This means that the earnings profile of ABAR is a lot stronger looking forward, and therefore the share price has rallied. Property developer Saru has today reported first half profits and revenue figures well down on the previous year. Revenue declined by 22% to 1.3 billion dirhams, and profit declined by 71% to 281 million dirhams. Although the year-on-year numbers are weaker, quarter-on-quarter figures are improving, and the company expects that the rest of the year will see ongoing improvements to profit and revenue. Although Saru has a strong list of projects that are still upcoming, we prefer Aldar as a property play in the medium term, also listed on the ADX exchange. This week's key stock is First Gulf Bank, listed on the Abu Dhabi Stock Exchange. First Gulf Bank recently issued its second quarter profit results. They were down 3% year on year to 775 million dirhams. Despite the decline, this result has outperformed other UAE banks, with strong contributions from corporate, retail and treasury divisions. The net interest margin actually expanded during the quarter to 3.75%. This is well above UAE peers. Also, the cost to income ratio is very low at 20.9%, as the bank has a low employee cost per unit of income and also has a low fixed overhead base. Given the constraints on UAE banking at the moment, this is a very favourable position. A total of 260 million worth of provisions were taken during the second quarter, particularly to exposure from Saad and Al Ghassabi groups in Saudi Arabia. FGB is our preferred bank in the UAE. The bank has a solid retail funding base, largely comprised of high net worth individuals, and are less reliant on wholesale funding costs, which have increased dramatically. Further, the bank has strong links with the Abu Dhabi ruling family for its shareholding. It has a diversified earnings base across treasury, corporate, retail and Islamic finance. Each division is growing strongly and has an attractive loans to deposits ratio of 103%, well below the UAE average of 110%, meaning that the bank is a lower risk play than others in the UAE. We believe that earnings growth will continue to be low during the second half of 2009, but will outperform UAE banks. And in addition, FGB is in a strong position to grow its market share and also earnings in 2010 once economic growth in the UAE and in particular the Abu Dhabi property market rebounds over the next 12 to 18 months. We retain a 12-month price target of 18 dirhams.14 versus the last price traded of 14.50. That's all for this week. Happy investing, Dom arigato, and sayonara!